Goedemiddag, welkom bij een nieuwe KoersKompas Podcast. Vandaag heb ik een heel speciale gast, Rick Rule, een legendarische belegger in de grondstoffensector. Hij heeft een carrière die meer dan 50 jaar lang is. Hij is een van de meest succesvolle en bekendste mensen in heel de sector. Dus ik heb een aantal vragen voor hem voorbereid, die ik denk dat wel leuk gaan zijn en educatief voor de kijker, voor de luisteraar. Mr. Rule, thank you so much for taking the time.
A pleasure. Thank you for the opportunity to speak to your audience.
Thank you. I know you're not a macro analyst per se, but I do wonder, do you often or sometimes use macroeconomic analysis, like your prognostications about a higher dollar or lower dollar or real rates where it's going to be in the future when you're looking at commodity investings, or do you stick mostly to the company specifics, the supply demand stuff?
Well, certainly I'm a credit analyst, so I'm much more focused on company-specific information. I look at the macro the way any credit analyst would, which is to say macroeconomic trends impact individual company fundamentals. As an example, if you think that a certain government's budget is unsustainable, irrespective of your macro outlook, irrespective of your political outlook, it impacts your opinion as to their ability to service their debt and fund their programs. So in that sense, I pay attention to the macro, but only as I see it relating as an input to the information around the micro, company-specific information.
Right, that makes sense. Maybe switching to the topic that's hot these days with the new headlines and all that. China, I think you all know China is very important to the global commodity markets. What are you seeing there? Is a stronger China with more stimulus and all that? Is it a necessity to propel commodity markets further in the next 5-10 years?
I would suggest that they're important, more important for the next 5. I think the important trend in commodities will be on the supply side, pardon me. On a global basis, we are underinvesting and have been underinvesting for many years in productive capacity. And what that means is that in as little as 2 or 3 years, we will begin to experience supply shortages. We can experience supply shortages without price increases if demand falters. And that's where China comes in. With regards to a China-specific comment, I would suggest that the intermediate term outlook for China continues to be bright, given the incredible investment that the Chinese people are making in their own education and in their infrastructure. They're in the same sort of sweet spot demographically that the United States was at the end of World War II. The difference is that the United States squandered too much of their advantage on consumption, while the Chinese seem to be focused on investment. The fly in the ointment, which is to say the part of that equation that has me nervous, is the opacity of China. The fact that 10,000 people in the Chinese Communist Party attempt to run an economy on behalf of 1.4 billion people. The feedback mechanism is not good. The banking regulation, the fact that capital often gets squandered on politically expedient domestic spending programs is a problem. But one needs merely to visit China and to experience literally millions of people striving to get educated, striving to get ahead, saving 50% of post-tax income, deferring enjoyment so that their children can enjoy a better future, observing the breakneck pace of infrastructure investment, to feel bullish about China in the intermediate term. assuming that 10,000 people who run the company or country, pardon me, don't make a fatal mistake in the nearer term.
Right. Switching to a commodity that the whole world doesn't really love too much, but China doesn't really mind apparently. Coal. I know that you're a contrarian investor, as all commodity investors should be. So I guess you love coal then.
I love it less simply because it's performed so well for the last 4 years.
Yeah,
in 2000, anybody who could add and subtract would have to love coal because it was all addition, no subtraction.
right.
The commonly held political viewpoint was that coal was going to cease to be used, and it was going to cease to be used very quickly. The problem with that thesis is it wasn't true. It simply wasn't true. The largest demand year for coal on record was 2023. 2024 is shaping up to be larger. Bart, I'm not contesting that putting large amounts of pollutants into the atmosphere is a good thing. I'm not even suggesting, although I don't know, that global warming is a man-made problem. What I am suggesting is that when Europeans and North Americans tell the rest of the world that they need to generate less carbon, the rest of the world says that you need to measure carbon output per capita, not per country. And Chinese carbon output per capita and Indian output per capita is very small compared to Western output per capita. The Chinese then point out that the majority of the sacrifice with regards to carbon has to be borne in North America and Europe, where they use more carbon per capita. They also point out correctly, Bart, that when you take into account carbon loadings, which is what coal is all about, that the historic contribution to carbon loadings have all incurred in the West. You have 1 billion people on Earth that have no access to primary electricity. They want to live, Bart, like you and I. And in the near term, that involves the cheapest, most dispatchable source of baseload power that they can find, which is coal. Whether we or Angela Merkel or that noted energy physicist Greta Thunberg agree with that assessment is irrelevant. It's true.
Right. Yeah. I was telling some people this earlier. I think these people are more concerned with getting energy than concerning themselves about where the energy is going to come from. That's the second, on the back burner.
Well, people in emerging and frontier markets will argue, rightly, that it's our problem. We generate more carbon per capita than they do. And the historic loadings, which is to say the carbon that's in the atmosphere from man-made sources, is 90% contributed by developed countries. So the undeveloped countries suggest that if we're concerned about carbon, that we bear the cost. If we decide to bear the cost, then the economic consequence of that can be examined simply by looking at the economic performance in Germany for the last 10 years. It is not pretty.
Right. Yeah. Moving off to gold, perhaps. Is it also a commodity that really, because I like to look at, for instance, like the dollar, because generally it's inversely correlated with the dollar index and all that kind of stuff. But it seems gold has found a new driver, so to speak. It's not really moving on macroeconomic factors anymore, or well, I guess it is, but what I'm trying to say is it's moving on sovereign entities buying a whole shitload, let's say, to put it bluntly, of gold, and it just keeps going up. What are you seeing there? Is this a big change that's going to continue to happen?
Sadly, Bart, at least sadly for younger audiences like yours, I think gold will continue to do well. I say sadly because through history, gold's function has been as a form of insurance. And when a set of circumstances occurs that causes you to need insurance, it's invariably not a good thing.
No, it's not.
The point that you make about the fact that the buyers of gold are primarily central banks is accurate. And I think that's occurring for two reasons. They're related. The first is the weaponization by the US government of the US dollar. Regardless of whether you support the Russian activities in the Ukraine, there can be no arguing that the United States government stole $300 billion in Russian assets in US treasuries. The message, if you're a non-US sovereign government around the world, is crystal clear. If you don't allow the extraterritorial imposition of US political will, the US government will steal your US dollar denominated assets. If you're a country that has policy disputes with the United States, and there's very few that don't, you need to begin to diversify out of the US dollar. You need to begin to develop settlement mechanisms outside of the US dollar so that your sovereignty is protected from the overreach of the US government. And I say that as an American. What countries might those be? Saudi Arabia, Russia, Iran, China, India, Brazil. The list is endless. And as those countries come to understand that for strategic and political reasons, that they have to develop settlement mechanisms outside of the US dollar and reserve assets out of the US dollar, the best remaining alternative is gold. Because as bad a currency as the US dollar is, it's better than all of the other currencies. The Chinese don't want rubles. The Russians don't want renminbi. The Brazilians don't want rupiah. Traditionally, that problem was solved with US dollars, but increasingly that problem can't be solved with US dollars. The second reason the foreign central banks are moving out of US Treasury securities into gold as a reserve account is because the US Treasury security is becoming a lousy instrument. A lousy instrument in the context that the US 10-year pays about 4%, in a currency where I would argue not the CPI stated rate of inflation, but rather the deterioration of the purchasing power is increasing at about 7.5% compounded. If your country decided to invest in US treasuries, 10-year treasuries, what would happen is that the purchasing power of the Dutch people would decline by 2.5% compounded for 10 years. It's a lousy deal. In the period 1982 to 2022, it was a pretty good deal. US real inflation rates were low. US interest rates relative to global interest rates were high. The US dollar was strong, and the accumulated sins of US politics were fairly low. I believe all of that changed in 2022. So I believe that foreign central bank buying is intelligent, both because of the weaponization of the US dollar and because of the increasing deteriorating credit quality of the United States, of the US Treasury.
Yeah, that sounds very, very accurate indeed. After my favorite topic, uranium. I've been in the uranium market, I think since when did I get in? When did I start to wait? I got in 2018 or 2019, which I think when Cameco started cutting back production a little bit, I think, and it was the bottom of the cycle. Of course, I had to wait a little longer for it to really take off. But I was watching an interview with, I think it was you. I'm pretty sure it was you. And you made a very interesting remark that I think the first one the first time that I heard this remark, it's about the Chinese and how they procure their uranium, their fuel. You were saying that they need a 10-year stockpile. It's mandated by law pretty much, or I'm not sure.
It isn't that it's mandated by law, and it isn't unique to the Chinese. If you were, let's say that you and I were building a nuclear power plant, unlikely, I realize.
Yeah.
So let's make it the Chinese to make it more plausible. And let's say that this nuclear power plant would cost 6 billion euros to build. Traditionally, about 60 or 70% of that would come from debt, bank debt. And the lenders who are putting up the bank debt are increasingly requiring enough fuel to be secured to amortize that debt. If it's 15 years of debt, to be substantially amortized would take 10 years. So the lenders to build these new nuclear power plants are requiring often as a loan condition the contracting of enough supply of uranium so that that debt, in this case, $4 billion, 4 billion euros, pardon me, could be amortized. It isn't so much that the governments are requiring these strategic stockpiles of uranium, unless, as in the Chinese case, the banks are government controlled. It's that the lender rationally requires that the utility will have enough fuel to generate enough electricity to pay back the loan. It's this fact, Bart, and the fact that the market for uranium is going to a term or contract basis rather than a spot basis that is the single most important factor to understand in the uranium business. Mercifully, for those of us who understand it, probably not 1 in 100 uranium investors does understand it. So we have a wonderful competitive advantage.
Yeah. Can you maybe speak on, it's more of a hot topic, and I think it's going to be much more of a hot topic soon. But it's heating up. The divide between East and West, and how maybe we'll go back 50 years and see a split price even.
I'm less concerned about that than many others. I believe that commodities are fungible. I believe that there is a sub rosa struggle, less and less sub rosa, over control of resources. But I also believe that uranium is fairly fungible. So that to the extent that the Chinese, as an example, access more Kazakh supply, that the Australian product and the Canadian product that currently services the Chinese will go to places that the Chinese displaced. In other words, I think with regards to uranium in particular, that global geopolitics are less important than other people do. The sole exception to that is the enrichment and fuel market. Yeah. The Russians, in terms of the latest data that I have seen, control about 53% of the world's enrichment capacity. We would be able to do without Russian enrichment, but it will require substantial underfeeding, which is to say we would use a lot more raw uranium than we would with access to Russian capacity. Now, Orano, the big French firm, and Westinghouse, now controlled by Cameco, are racing to build enrichment capacity. And I think that it's a problem that will be eliminated in 3 years. I think that the geopolitical context of uranium, the competition for access to uranium between the East and West, or even between Western blocs, which is to say, Japanese looking for access, the United States looking for access, Europe looking for access, is an overstated problem. Because I think, as we've seen with the embargo on Russian oil, they don't work. This stuff is very, very, very fungible. It finds its way onto the market. And when it finds its way onto the market, the sanctioned material displaces other material, which then finds other markets.
Right.
What is interesting to me in the uranium market, and something that I thought wouldn't occur for 10 years, is the incredible proliferation of small modular reactors. I thought as recently as a year ago that is something that would impact the market 10 years from now or 15 years from now. And I remember in an offhand way saying that at a conference a year ago. talking about the development of technology. And I was followed as a speaker by somebody from the US military establishment who said small modular reactor technologies aren't something of the future. The US Navy has been deploying them on submarines for 40 years.
Right.
And you will be surprised in the next 2 or 3 years at the proliferation of SMR technology and the ability that SMR technology has to impact contracting for uranium within 5 years. And we're seeing precisely that now. We're seeing all of the big data processing firms, the Oracles, the Googles, the Facebooks, the Microsofts, the Teslas, all of them looking for access to highly reliable base load powers
Today,
for data
Amazon.
center applications. And the most logical supplier of that power is either the existing nuclear fleet or small modular reactors. And so I was, mercifully for me, wrong in that assessment. I had assumed that it would impact demand 15 years from now, when in fact it's impacting contracting demand right now.
Right. Yeah, we're seeing a lot of announcements by the big tech firms that can really speed things up. Today we saw something by Amazon. They're gonna do nuclear earlier this week. Google. Yeah, it's really.
Bart, the importance of this is that if, let's say, Microsoft decides to access uranium from a small modular reactor, built conveniently, of course, by Bill Gates, those SMR reactors are more like billion-dollar projects than $6 billion projects, but the economics are the same. To build that billion-dollar project, the developer borrows $600 or $700 million, and the banker insists that that small modular reactor have access to enough fuel over 15 years that it amortizes the loan. That's the important difference. The future of the uranium market is in term or contracted market rather than in spot market. And that means that for the producer, unlike in the spot market where you never know the price you're going to receive for your material 3 years from now, or how much you can sell, you can contract the production with an investment grade counterparty, and you can know how much material you're going to sell and approximately how much you're going to sell it for. That means that your cost of debt capital is going to be lower because there's more security for the lender. And it means your cost of equity capital is going to be lower because lazy old analysts like Rick Rule can look at the contract terms and see how much material you're going to sell and for what price. And that's a critical difference.
Yeah. The thesis has certainly evolved. When I got into this, it was basically I was thinking, well, the price is well below the level that it's needed. It's gonna have to rise. But in the meanwhile, a few 5 years later or whatever it is, the situation is this might turn into a secular growth, not based on demand, or it's gonna be something that maybe goes up 5% or so per year. And
well, I think that's accurate. I think that'll really be a function of production. The truth is that the current spot price at $85 is probably sufficient if it can be translated into a term to support new productive capacity, but not enough. The difficulty with an $85 fixed price is inflation. And so inflation needs to be built into these terms, and increasingly inflation is built into these terms. That's very important. The second factor, Bart, is that if you are a nuclear power plant operator, a little bit of fuel goes a long way. It is not infrequent for the total cost of the plant, including amortization and depreciation and cost of capital. It's not unusual for the uranium cost to be 5% of the total cost of operating the plant. If you have $5 or $6 billion invested in the plant, and you're using, let's say, 500,000 pounds, 200,000, 250,000 kilos of uranium a year, and the price of uranium doubles, it doesn't matter to you. It absolutely doesn't matter to you. You have to use that uranium because you have to amortize the $5 or $6 billion or euros that you have invested in the plant. And as a function of cost, with the uranium itself being 5% of total cost, if it becomes 10% of total cost, it's not pleasant, but you need to have it to amortize the other 90. Those simple economics, and the fact that those simple economics gets translated into contract terms and lender requirements for contracts. That's the sea change in uranium that only one investor in 1,000 understands.
Yeah, it's hit the nail on the head as far as I'm concerned. Yeah. People like to talk about like what inning are we in, so I'm gonna maybe ask the same question, because mostly like I look at this thinking the term contract cycle is pretty much everything that matters. The rest is noise, as far mostly. That's what I tell people. And I mean, if you subtract a big Ukrainian contract, we haven't had a single year where we've reached a replacement rate. So actually, you could argue that maybe we're not supposed to talk about innings because we're not even starting the game yet.
Well, I think there's a lot of truth in what you said. I believe, but I don't know because the market's opaque, the Japanese inventories are higher than we would believe. So I believe myself that there's more above ground fuel than the market believes. I also believe that the pace of Japanese restarts has become strong enough that above ground inventory will disappear into the Japanese market. When the Japanese shut down their plants, you had two things happen. You had about 20 million pounds a year in systemic demand go away. At the same time, you had at least 100 million pounds of inventory that was no longer held as fuel, but was held for sale because the Japanese wouldn't burn it. So we're going to work through that. And we're going to work through it in 2 or 3 years, likely in Japan. Right. In terms of innings, it's an interesting circumstance because the changes in the contract market that you and I described don't apply to most of the juniors because most of the juniors don't have any uranium. They're looking for it. Or if they have it, it's unlikely to be developed at any price remotely resembling a price which is feasible to achieve. So you need to understand that in the universe of uranium juniors, perhaps there's 100 of them. The circumstance that we described probably applies to 10 or 12. So for most of the uranium juniors, they are in inning 0. And 15 years from now, they will still be in inning 0. Because if the price of something that you don't have any of goes up, it doesn't matter particularly to you. It's important that people understand that their uranium company should have some uranium. It is also true as a speculator that when a market really gets hot, the dumbest ideas of all, ironically, perform the best. So a company that's run by a bunch of used car salesmen that has uranium only as a component of the name on the share certificate can perform extremely well because there's a whole bunch of stupid buyers out there. But it's an extremely risky investment strategy.
That's probably the time we ought to sell. I'd say that's probably the last phase.
Well, I won't own any to sell of those. The changes in the market that we're talking about, I think will be particularly attractive in the high quality developers. The people who would otherwise be unable to develop their projects and would have to sell them to a bigger company, they won't have to sell them now because they will be able to forward sell by contract enough material that they'll be able to get conventional bank financing to build their mines. They may choose not to do it. They may choose to sell anyway. But the fact that they're able to raise the money will add competitive tension to the process. Historically, if you developed a uranium project, you had to sell. You had to sell to Rio. You had to sell to Cameco. You had to sell to China General Nuclear. That isn't the case anymore. You will be able, like Paladin has done, to build on balance sheet. And this will add a lot of dynamic tension. In addition, the countries around the world that believe they need access to nuclear energy that don't have it, say, as an example, India or Saudi or the United Arab Emirates, never mind Korea, Japan, Republic of China, People's Republic of China. All of those companies will, I think, be looking to participate in the financing of uranium mine construction in return for guaranteed offtake. They may not own and operate the plant. They may contribute quasi-equity or subordinated equity in support of debt, or they may choose to support the debt directly as a guarantor so that they can have access to 20 or 30% of the offtake. These are really, really, really boring considerations that are really critical to understanding how to invest in uranium and uranium stocks.
Yep, sure. Yeah. One last one with the uranium subject before we move on. It's my favorite one of all, actually. Do you have any thoughts on the Alligator River uranium province in Australia? Is it an area that maybe needs more attention?
I think it does need more attention. Australia is challenging. It still has a 3-mine policy. And the political establishment in Australia, particularly the Labor Party political establishment, has a very strong anti-nuclear and anti-uranium bias. There are many parts of Australia that are attractive from a geological viewpoint for uranium. Alligator River, of course, having been around for 30 or 35 years, so it's a fairly well-known province. Some of the legacy problems there go to historic antipathy between the mining industry and the Aboriginal peoples. They were dealt with quite shabbily, they being the Aboriginals, 25 or 30 years ago. And the political impact of this shabby treatment is being felt today. Local Aboriginal groups, which should be the allies of the mining industry, have often a pathological hatred for them, including at Alligator River. The second challenge is the intellectual left in Australia, something that Europeans know well, who have an antipathy to development of any type, but a particular antipathy to nuclear development. So in summary, when I look at Alligator River and I look at the historic data and I look at the macro geologic context, it's a really, really, really interesting place. When I juxtapose that with the social, climactic, and political reality, it falls back into line with other provinces.
Right. Yeah. Yeah, there are some issues. Oil. The commodity itself hasn't really recovered from that 2022 downfall, or it went down from 120 to 70. What do you see in there? Can the oil boil wake up again here? The commodities have done rather well.
For somebody your age, with a 5-year and 10-year horizon, oil's a no-brainer. It's just a no-brainer. Today's oil price has everything to do with the implementation of new technology in old places, particularly in the United States and Canada. The most mature oil province in the world is the United States, and we've doubled production in 10 years as a consequence of the implementation of new technology and very low cost of capital. We are running out of tier 1 locations in the US. So unless technology improves substantially, the increases in US production that we've seen are a thing of the past. The investment community's outlook for oil is shaped very much by the political belief, particularly European political belief, that peak oil demand occurs in 2030 or 2032. So reserves on a net present value basis assume tapered demand from 2030 forward. I believe peak oil demand occurs in 2065, which means that I have a very, very, very much longer tail demand in my supply-demand forecasts. The third thing to consider is the fact that the oil industry, including state-owned oil companies, by their own admission, are underinvesting in sustaining capital to the extent of over $1 billion per day. Per day. This is a capital-intensive business. If you don't reinvest sustaining capital and new project investment, your ability to produce in the out years declines. So we have a circumstance where, absent new developments in technology, US production is peaking. It's the US that's been the surplus for the last 10 years. We have a different circumstance where, rather than declining, oil demand on a global basis is increasing. It's not declining, it's increasing.
Yeah.
And it will increase for a long time. Remember that 1 billion people on Earth have no access to primary energy at all. They want it. And the third thing is that on a global basis, particularly acutely with state-owned oil companies, the industry is underinvesting $1 billion a day. The consequences of that can be observed by looking at two companies, Pemex, the national oil company of Mexico, where as a consequence of 40 years of underinvestment, their productive capacity has fallen by 80%. And Venezuela, where as a consequence of 25 years of underinvestment, their productive capacity, despite having the largest oil reserves in the world, larger than Saudi Arabia, their productive capacity has fallen by 70% in 25 years. The consequences of underinvestment don't appear for a year or 2 years, or sometimes even 3 years, but they do occur. And we are underinvesting on a global basis over $1 billion a day. It is important that young investors, particularly like yourselves, understand all three of these trends, and that you express them by buying companies that are solidly cash flow positive at today's oil prices, companies that are investing enough in new project investments and sustaining capital investments that their cash flows are going to be stable in the out years, and also companies that are shareholder friendly, that are either engaging with surplus, not primary cash, in share repurchases or in dividend increases. Mercifully, these companies are numerous. And my suspicion is that an investor your age, who is investing for the 5-year time frame, the 10-year time frame, and the 15-year time frame, cannot go wrong assembling a portfolio of high quality oil and gas companies.
Makes sense, yeah. Looking at the whole commodity complex, maybe put a number on it, how bullish you are when you look back on your past as a commodity speculator and investor. The 70s were the holy grail.
With the caveat that I don't know if we're going to have a global recession or a depression. I'm not an economist. Absent a synchronized global recession or depression, I am more bullish on commodities than I was in 1998. The period 2000 to 2010 was the greatest period in my professional career in terms of the accumulation of wealth in the commodity sector. So I am more bullish about commodities today than I was in that decade, which was the best decade that I personally ever experienced. The fly in the ointment would be a broader war, which is something I think you need to consider. I'm not saying it's going to happen, or a synchronized global recession or depression. You can reduce demand and cope with reduced supply because the prices don't go up. The consequence of that is that I think investors your age need to have a much greater allocation of resources than they otherwise would have, but they need to understand the systemic risk to their portfolio, not just their resource portfolio, all of their portfolios, that would occur as a consequence of a synchronized global recession or a depression. I'm not smart enough to tell you if we're going to have one. I am smart enough and I'm old enough to know that you need to plan for contingencies like that. You need to structure your portfolio so that you survive events outside of your thesis.
Right. So far, I mean, not that my opinion is worth too much, but so far I'm going with the thesis that we're actually coming out of a slowdown. But there's also something that you're setting up here that's coming up later this week. Can you tell us a little bit more about that event?
Sure. One of my chief activities now is investor education, which is why I do so many interviews like this.
Which
and I have a business called Rule Investment Media. And we do a lot of things for free. As an example, any of your listeners who want can go to my website, ruleinvestmentmedia.com, list their natural resource stocks, and I will, for free, rank them. No obligation, no charge. I do this because the people who I rank portfolios for often decide to buy investment education products from me. Once a year, I put on what I believe is the finest natural resources investment conference in the world in Boca Raton, Florida. And we sell that to people who have submitted portfolios for our evaluation. But once every 90 days, once every 3 months, we do an online conference called a boot camp. These boot camps are very deep dives into one specific topic. We've done silver, we've done uranium, we've done royalty and streaming, we've done prospect generation. The deep dive that we're doing this Saturday is on tier 1 deposits, investing and speculating in very, very, very large deposits. Deposits with in situ recoverable reserves and resources at today's commodity prices that exceed 10 billion euros. Companies that can generate €1 billion a year in revenue for at least 10 years. Companies that will be in the best quartile worldwide in their commodity, in all-in sustaining costs, and deposits that will be in the best quartile worldwide in their commodity in terms of return on capital employed, but at any rate, better than 25%. We will attempt to teach you how to find pre-development stage companies that have access to world-scale deposits, development stage companies, producers who are seriously undervalued and or will be taken over, and also for the more mature parts of your portfolio, identify the major multinational mining companies that have access to these absolutely world-scale companies, which will benefit from all of the supply tensions that we've talked about in the interview up to today. This boot camp is not for tourists. This boot camp is not for people who are interested in investor education as an entertainment product. We're going to give you 7 or 8 hours of how-to discussion. You're going to have access to the tapes, the recordings of the conference for a year, and you're going to need them because we're going to give you more information in 7 or 8 hours than you're going to be able to absorb in 7 or 8 hours. So in order to get your money's worth, you are going to have to play the recordings a couple times, 2 or 3 times. The price for this is $99 US. gold-plated money-back guarantee. If for any reason you don't think that you got your money's worth, simply email us. We'll give you a full refund, no questions asked. We would prefer it if you told us how we failed you so that we can make the product better. But there's absolutely no requirement, absolute money-back guarantee. The only thing I can say is if you're a tourist, if you are somebody who isn't really interested in improving their investment performance or their speculative performance, don't come. This is not going to be like reading the comics. This is going to be a deep dive and very hard work.
This sparks what let's maybe keep it to the last question. I don't want to take too much of your time. I could speak to you for probably days, but one last one that this education that sparked a question in my mind. There is a shortage, I think, in the commodities sector of talent and new people coming in, and that's also a hallmark of the bear market that's been out of favor for so long. Can you maybe speak on that, and how do we get that going? Is that maybe like a bottleneck to, you know?
It's a huge challenge for us. If you look at me, 70-year-old, old, bald, fat, white guy, you are looking at the management profile, and for that matter, the working profile in extractive industries. There's a 40-year gap in talent. When I went to the University of British Columbia in 1970, in my minor, geological engineering, there were, if my memory serves me correctly, 290 incoming freshmen in that program. Last year, there were 8.
8.
If you are a young person with a trade background, I would absolutely positively consider mining or oil and gas. They're deeply unpopular. The whole labor force will be retiring in the next 10 years, the whole labor force, which means that your upward mobility is unlimited because all of your competition is either dying or leaving. If you have a technology background, if your background isn't trade, but rather academic in STEM, science, technology, engineering, manufacturing, also consider extractive industries. We have a critical shortage in the mining industry and the oil and gas industry in all of the technical applications, in geology, in engineering, in finance, in operations. These will be absolutely wonderful careers. It's been a wonderful career for me. When I look back, when I think about my good fortune and the travel that this industry has afforded me, the community that I've been able to inhabit, the interesting, nice people that I've operated in conjunction with for 50 years, I couldn't have scripted a better life for myself. And I came into it during a period of time when it was extremely crowded. The next generation comes into it in a period where it is extremely uncrowded and the opportunities are in fact greater. Now,
can that maybe turn into a problematic for future growth? Maybe that becomes like too much of a bottleneck, or
markets correct themselves. What will happen is that the employee pool in the mining industry will come to look less like you and I. It will be less male and less Caucasian. It'll be Chinese, and it'll be Indian, and it'll be Persian, and it'll be Brazilian, and it'll be Indonesian, and it'll be highly competent. It'll be great, but it'll take us a decade to get there. Markets work. You know, Bart, if you had a choice between, you know, working in a Dutch bank for 85,000 euros or working at Royal Dutch for 160,000 euros, you might consider the two choices for, say, a week. And then all other things being equal, you would go where the pay and the working conditions were better. And that's how we'll compete.
Yeah, that makes total sense. They correct through time. There will be some time needed, but it will adjust.
Yep.
Mr. Rule, thank you so much. I appreciate it. Thank you for speaking to my audience. It's been very, very educational, and I encourage everybody to look at your upcoming event there. It seems very enticing.
Thank you for the opportunity. And again, I invite your listeners who care what I have to say about natural resources to personalize it. Go to my website, list your natural resource portfolio. Please, by the way, no crypto, no tech stocks, just your natural resource stocks. I'll personally rank them, and I'll comment on individual issues where I think my comments might have value. The website is ruleinvestmentmedia.com.
Sounds good. Thank you very much.
Thank you, sir.